Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by global market specialists Nevruzi and Joann Spadigam. Okay, well, since I'm here in the room with Jan today in the US, let's start there. We're recording this as the market is moving in some, relatively violent ways, I would say. We've had a continued bear steepening in treasuries. What's your take on all of this, and what's your view on duration and curve going forward?
So, like you said, the long end has been selling off. By the long end here, I'm talking mostly about 10-year, 30-year treasuries, and it has been more or less like a global phenomenon, but mostly in the U.S. And I think there's a couple of drivers there, and I'm going to abstract from the front end, which is really driven by monetary policy. But on the longer end, there have been a couple of, I think these kind of like big thematic shifts that people are paying a lot more attention now that the Fed is more or less on pause, or at least towards the end of its cycle. For one, we've been having a lot more conversations about price deficits and a lot of issuance that might kind of like lead to supply indigestion and eventually steepening or like duration needing to price at higher yields in order to find suitable buyers. I'm not so sure if that's the case yet, or if we simply ran out of topics to talk about. It's also hard to just exactly pinpoint what is the right level of supply. In 10-year equivalents during COVID, we issued a lot more. We didn't see anything similar. Similarly, swap spreads or anything that you would compare treasuries to, they haven't really implied that treasuries are significantly oversupplied yet. But it's certainly a topic that keeps coming up. And if we do continue in this path, by the next year, we probably will see a decent amount of increase in option sizes, which I'll admit more supply should weigh on yields. Maybe less on the U.S. and rest of the world, but it still should. But again, as a percentage of GDP, and nominal GDP has been growing pretty quickly, it is they go hand to hand. You issue more debt, but at the same time, the assets of your buyers also go up. If you're an insurance or pension company with nominal GDP growing the pace it is, well, the premiums you get in will go up to, your assets will go up to, your liabilities will go up to. So you have a larger base to invest in, or like larger needs for investing. Although they might not grow simultaneously, I think eventually the demand side also catches up. So hard question, but in the near term, I think that adds upward pressure to yields. Other thing is other issues such as a negative carry of being long these positions. At some point, when you're looking in just pure cost of holding basis, these treasuries are expensive from the longer end. It's not a massive amount for longer dated stuff just because of the duration that you get per dollar, but still, it does start weighing. And if you know the Fed's kind of telling you, I'm going to be unchanged for the next 3, 6, 9 months, well, maybe you just assume that now is not the time to be long these. Psychologically, maybe something else changed, and you just have, in a period of dormancy, it's not that crazy to see these longer dated rates just catching up to the overnight rate and the curve bear steepening. That was one of our themes since August, that we have a lot stronger conviction in the curve steepening than outright duration. And we could see a scenario where data disappoints and the curve bull steepens led by 3-year and 5-year, but we could also see a scenario like we're having now where the long end drives the moves higher and yields start pushing higher because of all of these factors. So much stronger view than steepeners and a lot, I guess, lower conviction on outright duration.
What about the front end? And you mentioned it kind of briefly, and obviously, like you say, it's kind of bearish steepening now, so it's being driven by the long end. But how do you feel about the front end?
I think the front end, the risks for the front end are now, and when I talk about front end, I'm going to kind of stick to the 2 years, 2.5 years and in. I think the risks there are more tilted to the downside in yields, actually, because the Fed, so we looked at historically how the curve has behaved, or the kind of pricing the front end has behaved in relationship to what the Fed projects they're going to do. And when we look at what the Fed tells us in their dots, so the quarterly projections, if the Fed tells us they plan on hiking 100 basis points or cutting 100 basis points, it's unlikely that the market prices in even more tightening than what they have. It makes sense. It's much easier to ease than tighten, and markets play alongside. So the forecast of 50 basis points of cuts for next year should, in my view, act as a soft ceiling for where rates would go, unless we get like a sudden resurgence in inflation, which makes these forecasts outdated. So because of that, I think there's not much room for 2-year yields to go up higher from here. Of course, you're paying a negative carry, like 4 or 5 basis points a month, which is not nothing, but daily implied moves in options markets are about 6.5. So it's not that massive amount if you have like a view that things might slow down. If I had to bet on a direction for the economy, I probably would take decelerating growth over re-accelerating growth. So I think now the downside in yield is much wider. Like the probability for that happening is still there, while the upside is kind of capped. So if I had to, I don't know if today is the moment, but directionally, I think the risks are more tilted to being, to yields ending up much lower than high from here in the short end.
So a bit of a twist.
A bit of a twist steepening, exactly.
Nice, I like it. All right, then let's switch over to the euro area, Joann. We've got lots of European inflation data coming out this week. How's that looking so far, and how much does it matter, I suppose, for the ECB in the weeks and in the months ahead?
Yeah, so the German print that came in this morning was actually slightly lower than expected. And I do think that does put some downside risks on the headline euro area print that we're likely to get. So initial expectations for that were 4.5% year on year, and that's looking something more like 4.2%. I do think the headline inflation numbers do come as a positive for the ECB, and it really does reinforce the story that the ECB is done hiking, particularly given the message we got at the last meeting, and the inflation prints kind of confirm that story. So we do think next month's meeting will not be live, and we're unlikely to see a move, even though I suppose there could be some pressure in the December meeting. So I think the general kind of trend is kind of positive for the ECB and for our views in general. I suppose the market will kind of keep focusing on these inflation prints, but also the growth numbers as they come out and implications for that on the policy cycle as well.
What about the funding side of things? We're obviously getting into kind of deficit season in the euro area. We've had some funding updates as well. We've had France and Italy. How did those numbers kind of tie in with your expectations, and what are the implications for markets there?
So the funding numbers have been interesting. France has noted that their deficit for 2024 will be around 4.4%, so barely in line with what they've said at the start of the year. And Italy's deficit is going to be higher than they sort of said at the start of this year, where they telegraphed a level of 3.7%, and that's looking kind of above 4% for 2024. I think it's fairly interesting for a couple of reasons. One, the Italian story was fairly well televised. We've got headlines around Italian deficits, but a lot of the last month kind of flagging that it would be higher than they forecasted for 2024. But I do think there's a bit of kind of optimism around these numbers in the sense that the growth picture will be fairly important in determining how the deficits actually come out at the end. And we could actually see upside risk to these deficits going forward if the growth picture does actually deteriorate and doesn't come in line with the estimates that they did use. But I think overall the message for supply really is that we should kind of see another year where supply is elevated. I think for France specifically, their bond supply for next year will be higher than this year, driven by, I suppose, the fact that they will be running down their cash account less than they had last year. So the amount of bonds coming in will be higher, even though the actual deficit is lower. I think kind of this picture of quite a lot of supply, along with the year next year where we have lots of QE in the sense that APP QT will be running in full versus kind of a staggered approach this year, plus a potential start to PEP as well, PEP QT, does actually put up net supply pressures for next year. And it's been fairly interesting, I think, just kind of post ECB. John's already talked about the vast steepening pressures we've been seeing in the market. And I do think there's this kind of focus away sort of from the front end and potentially to the longer end of the curve, where supply, I think, is quite an important factor for the steepening that we're seeing kind of post ECB, with lots of supply kind of weighing at the back end. And again, the twist steepening does seem fairly, I suppose, sensible proposition in the euro area as well, given that the front end is more pinned down by what the ECB has kind of signaled about rates and more exposed to, I would say, to the potential repricing based on the growth vector.
Yeah, and I guess particularly when you compare, current consensus to what we're expecting from the ECB, with a cut as soon as March, then, if that materializes, the market needs to reprice a little bit at the front end. Okay, so thinking about that, you mentioned the possibility of quantitative tightening, QT being accelerated perhaps the middle of the year. This is obviously something that since the last hike from the ECB, it has really been front and center of the tightening debate. It's all about, what other tools can they use, and particularly with regard to the size of the balance sheet, I think they're thinking about the ways in which they can tighten using that. And of course, the discussion hasn't just been about QT, on whether that be on the APP or on the PEPP PAP, but also on their MRR, the minimum reserve requirement ratio. There's been lots of sort of ECB sources articles around, some suggesting that they would raise that to just a couple of percent higher, but some, touting almost double digits increase in the minimum reserves. What's your take on that? How likely do you think something like that is?
So the Hawks Select Committee some of the Hawks Select Committee do like this idea of minimum reserves being quite high, as we got some comments saying that it could be as high at 10%. And these don't really seem to be driven by monetary policy and monetary policy concerns, as it does seem to be really about reducing, I suppose, the cost of the ECB of excess reserves. We don't really think a move to something like 10% is likely. Something around 2 to 3%, which is more in line with what they had in the past, is more likely, we think, and more likely not would lead to too much market impact in terms of kind of either cash rates or swap spreads. A larger increase will probably have a few different kind of effects on the system. Not most importantly, I suppose, or most largely, the impact will be on bank profitability. And then there are second round impacts that are likely, but it's a bit harder to kind of pinpoint what those will be, given that the way in which excess reserves are for different banks does differ quite a lot. As you can see, some banks being impacted more sharply by an increase in minimum reserve requirements, and some, I suppose, less so. So the second round of effects are definitely a lot more mixed and asymmetrical for banks, but any kind of increases, small increase, I was to say, to 2 to 3%, shouldn't have too much of an impact on the kind of market as a whole.
Okay, great.
So, as well, watchers will notice, but Imogen is in the room today with me. She's energetic as ever, but we're catching her at the end of quite the road trip in the US. We've seen a lot of clients, and I think that's kind of the burning questions that listener want to know. Why is she in this room, and what did she learn this week? What's the feedback to your views?
I'm in the room because I came all the way here to see you.
Well, let's go with that.
Yeah, Ross and I, Ross Walker, our chief economist, have been doing a busy road trip this week in the US. We've been seeing clients in New York and in Boston, so a mix of kind of real money and hedge fund accounts. And so, yeah, I've been a bit out of touch with everything that's going on. It feels like a big move in markets. I'm not going to comment on too much of that. I guess I'll just give a quick rundown on, what we've been focused on in our discussions this week and what clients have been asking us. I suppose starting at the front end of the curve and the BOE and everything like that, I think from an economic perspective, our sort of pessimism around the growth outlook in the UK was very much shared across the client base. I think probably the most optimistic view we got was one of kind of stagnation and the UK just sort of bumbling along. And then obviously, that ranged to much more pessimistic views about a perhaps deeper and more prolonged recession. On the inflation front, there was lots of questions and comments about the fact that despite how, until this week, it felt like the market had become much more complacent around the UK's inflation outlook, but really it did still look like a kind of outlier globally when you compare, I guess, the level of core inflation right now. And a lot of the conversations that we had centered on the upside risks to inflation, and therefore, I suppose, the kind of risks that the BOE needed to do more rather than less than we were expecting. So I don't think we got a huge amount of pushback on our kind of central scenario that, the BOE are probably more than likely done at this point. We think the peak is in. But certainly the discussion and the way that it felt like the skew of risks were towards inflation kind of being higher and stickier still than we expect, and therefore the Bank of England having to do more. And really all of that for us, the risks there center on, I guess, the labour market and more specifically on wage inflation. And I think our view that, this kind of Table Mountain narrative that's sort of global central banking mantra right now, if that's going to be challenged anywhere in terms of, rates having to be higher than we're expecting, so a bit more like an Everest kind of mountain than Table Mountain, rather than it being challenged kind of earlier to the downside, then the UK was really the place where, that would be most vulnerable to, not significantly, but a higher peak than we're expecting. And I think that view was really shared across our client base. I guess the other thing at the front end that dominated a lot of the discussion, and perhaps that's a kind of UK versus US thing, but something that we haven't been talking about for a few months as much as we were maybe sort of 6 months ago, was this mortgage pass through. And especially the kind of timing for when we thought that would be, I guess, most relevant in the UK. So, when do we see this, real tightening bearing down the most on demand, which for us is probably about the middle of next year. And again, this point was kind of raised frequently, which is something that we were kind of defending, like I say, many months ago in the UK, around the fact that, only a third of households have mortgages, and therefore doesn't really matter for the transmission mechanism, which we've kind of, I suppose, defended it a lot of times on this pod. But the sort of short answer is yes, we think it does. If you add in the proportion of private renters as well, who are obviously very exposed to higher rates, then that proportion of the market hasn't really changed. So you still have kind of 50% of people directly exposed to the rate increase impact. It's just taking a long time for that to feed through. Further out the curve, we discussed a lot the supply outlook in the UK. We've talked about that a lot on this podcast. I think the questions that we got a lot, or the pushback that we got, was, supply is high everywhere. Does this really matter? And certainly, given, I suppose, the market moves this week and everything you've been through, Jan, we discussed a lot the kind of relative increase in the UK versus the size of the market and what we're seeing in the US. And very annoyingly, that was the one chart I didn't have in my pack, which I think was the one I really needed this week. But we have a nice chart that compares, just how much the net increase of supply really is this year and in the years ahead in the UK versus the US, and is relative to the size of the market. And it is really quite a stark difference. So even though we're talking about a lot more supply here in the US, there's kind of even more to come in the UK. And so, against that backdrop, it really didn't feel like there was a huge amount of demand for UK duration. It felt to me like the investor base here was really thinking, or almost waiting for, kind of liquidity and volatility conditions to normalize before wanting to be sort of fully involved in the UK again, which, I worry becomes a little bit of a vicious circle, because if you have everyone on the sidelines, liquidity and volatility conditions don't really ever normalize. But yeah, from a trade perspective, I think that it felt like there was a real lack of demand for duration still. There was no real pushback against being short gilts on a cross-market basis. We had lots of sympathy for steepeners, which is perhaps a little bit consensual at this time, particularly kind of 2s, 10s. And then also just a little bit away from rates, but on the dollar, our FX team have had this kind of bearish sterling view in the near term, but over the longer term in 2024, I think they see a little bit of a recovery and a bit more bullish, which is really largely centered on their dollar view, and that they see, this kind of dollar exceptionalism and this sort of soft landing narrative maybe taking some of the wind out, or that narrative slowing and taking some of the wind out the sails for the dollar, which would drive cable higher. And I don't think that there was a huge amount of sympathy for that. US clients seemed a lot more bullish the dollar than we were, or at least didn't see, I suppose, a catalyst for a weakening at this point. So yeah, we got a bit of pushback on the sterling view, I would say. And that's it really. Okay, nice and short and sweet this week, I think. I'll be back in London next week, and hopefully less volatile in terms of market moves. But we will also, of course, comment on that when we get back. Thank you both for joining me. Thank you to our listeners for listening in. And just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.